Welcome back. In this part of our video, we're going to be working on time value money calculations. This is where your HP10b is going to be extremely important. If you don't have an HP10b, you're going to have to figure out how to use the charts. HP10b is required, and it was also a required calculator in 502 financial accounting, so you should have one. I just pulled up my virtual HP10b to remind you how to set up your calculator. So if you haven't done this before, let me walk you through the process. We did set it up in 502, but of course it could have changed if it got bumped in your backpack or something like that, or you had to get a new one. So first things first, hit the down button and then the clear button. And then if your screen doesn't say one payment a year, you're going to have some problems. So a lot of times it's set up as 12 payments a year to begin, so I just set up my calculator to be 12 payments a year. That's the default. We want it to say 1. So to fix that, you're going to hit the 1 key, then the red down key, and then the PMT button. And then to make sure it worked, hit down, clear. And now mine says 1 payment a year. Again, that was 1, down, PMT. And to check it, hit down, clear, and you can see my calculator says 1 payment a year on the screen. The next thing you might want to do on your calculator, if you haven't figured this one out yet, it's a little late, but you might want to change your decimals because that seems to be causing some rounding issues for some people. And to change your decimals, you hit down, equal sign, and the number of decimals you want. Down equals 9. That's too many for me. I like 5. Down equals 5. And that's all there is to setting up your calculator. Once it's set up, you'll be able to follow through the steps that we go through in this chapter and solve all of these questions very, very simply without having to worry about which chart to use, when to use it, multiply, divide, I don't know. You don't have to worry about any of that. We're going to use the top row of our calculator, which we used in 502, and we're also going to be using our cash flow button right here, as well as our NPV and IRR buttons right here. So that's where we're going to be spending most of our time. So I'll be popping that baby back up in a little bit. So the net present value method compares the present value of the project's cash inflows with the present value of its outflows. The difference between the inflows and the outflows are referred to as the net present value. The two simplifying assumptions that we're using is that all cash flows other than the initial investment occur at the end of a year, and in reality they're probably occurring throughout the year. But for simplicity, we assume they're all occurring at the end of a given year. In addition, all cash flows generated by the investment are immediately reinvested at a rate of return equal to the discount rate. The discount rate is the rate of return that the company requires for its investment opportunities. It's like the minimum return we talked about when we were calculating residual income. So here's an example. Lester Company has offered a 5-year contract to provide component parts for a large manufacturer. We've got the cost of the equipment, the working capital, the relining of equipment in 3 years, that's like some maintenance, and then the salvage value at the end of 5 years. Then it tells us the annual cash revenues and costs are revenue of $750, cost of $400, and additional salaries, shipping, etc., cost of $270. So at the end of 5 years, working capital is going to be released. That's like that cash register. We put the money in at the beginning, we get it back at the end. And then Lester Company uses a discount rate of 11%, and we want to know, should we accept it? So the first thing we want to figure out are what are the annual net cash inflows. So that's the revenues minus the expenses. That's our annual net cash benefit for this opportunity, which is $80,000. And then we need to define all of our variables by when they occur. So this is what I've put together, and let's talk about how we arrive at it. So the first thing is the initial investment. Because it's an outflow, it's negative because we have to pay money out to purchase the equipment. In addition, we need working capital of $100,000. That's the money we put in the register to make change. So there's two outflows in year 0. Year 0 is effectively today, the day of the investment. So cash flow 0 in our calculator is going to be negative $260. Then we have annual net cash inflows of 80 for cash flows 1, 2, 3, 4. Excuse me, for cash flows 1 and 2. Cash flow 3 is different because it's the 80 annual cash inflow minus the 30,000 for relining the equipment. So that's why cash flow 3 is only 50,000. It's the 80 annual cash inflow minus the 30 we have to pay out to reline the equipment. Then cash flow 4 is another 80. Cash flow 5 has 80 in it, but then also the salvage value of 5, and then the working capital released of 100. So in that 5th year, we're getting the 80 annual cash flow, plus an extra 5 for selling the equipment, plus we get that initial working capital back. So that means cash flow 5 is a whopping 185,000. To get the net present value, it's quite simple. The hard part is done. Defining when these cash flows occur and if they're positive and negative is the hard part. The easy part is using my HP10b. So the first thing I do is hit down clear to make sure I don't have anything weird in there. And then I'm going to put in my numbers. So 260,000, I'm going to make negative with the positive negative button. And then I hit cash flow and it sets it at cash flow 0. Then I have to hit 80,000 for cash flow 1. And because cash flow 2 is also 80, I can just hit the cash flow button again and it'll also set it in for cash flow 2. Cash flow 3 is 50. So I hit 50 and then cash flow, and that makes it cash flow 3. Then cash flow 4 is 80. And then cash flow 5 is 185. The next thing I need to do is put in my discount rate, which I think was 11%. So you put in 11 and then hit the I button. You're putting it in as a percent, not a decimal. So not 0.11, but 11, and then hit the I button. Then you hit your shift key and the PRC key, because underneath you could see it says NPV. And that'll get us our net present value, which is 76,048. So the net present value of the investment opportunity is 76,048. And before we go to the quick check, it's probably important to note, though it's in a later slide, that we're looking for any investment opportunity with an NPV of 0 or greater. When the NPV equals 0, it means we're earning exactly the minimum return. In this case, the discount rate was 11%. Because our NPV is greater than 0, it means we're earning more than 11%. In fact, let me whip up my HP10b. Though I'm going to teach you this later, let me show you how you get IRR with your calculator, the internal rate of return, which is the actual return earned by the investment. Because we know we have a positive NPV, I know I'm earning more than 11, but how much am I actually earning? Because all the data is in here and I haven't erased it, all I have to do is hit the shift button and then the CST button, which if you look, it says IRR a year underneath. And that'll tell me the actual return. So I knew I was earning more than 11%, but by using the IRR key in my calculator, I can actually determine the actual return for this opportunity, which is 20.62, certainly more than 11%. So using our calculator just makes this stuff so much easier. All you have to do is carefully define your variables, and then it's a piece of cake. All right, let's do a little quick check action. So Denny Associates has been offered a 4-year contract to supply computing requirements for a local bank. We've got the cost of the computer equipment, the working capital required, the upgrading of the equipment in 2 years, the salvage value we'll get back in 4, and then the annual net cash inflow. The working capital is released at the end, like the cash register. You put it in at the beginning, it comes back at the end, and Denny Associates requires a 14% return. So what you need to do is figure out what cash flow, what cash flow 0, cash flow 1, cash flow 2, cash flow 3, and cash flow 4 would be. Why 4? Because it says it lasts 4 years. So I know I don't need to go past 4. So take a minute, pause the video, see if you can figure out your cash flows. You know your I is 14%, and see if you can get the NPV. Welcome back. Hopefully you arrived at the correct answer. If you did, it means that you took the cash flow zero as the 250 plus the 20. So there would have been an initial outflow of 270, negative because it's an outflow. Then cash flow 1 would have been the annual net inflow of 120. Cash flow 2 would have been the 120 minus the 90 upgrade that we needed to spend. So that would be a positive 30. Cash flow 3 would be the 120 annual inflow. And cash flow 4 would be the 120 annual inflow plus the salvage value plus the working capital. So that would be 120, 30, 40, 50, 150. You'd plug that into your calculator, add in your I, and then get NPV. And when you do, you should arrive at 28,156. So let's whip out my HP10b and see if this works. So the 270 initial investment in working capital is negative. Set that for cash flow 0. 120 is going to be cash flow 1. And then the net for cash flow 2 is 30. And then cash flow 3 is the 120. And then cash flow 4 is the 120, the 10, and the 20 for 150. And then we have to put in our investment required return, which is 14%, and then hit second NPV, and I get 28,156, which means that this investment opportunity is earning more than 14%. If I want to, while I have the info in, I can hit second IRR, and I can get the actual amount we're earning, which is 18.64%, or 65 if you round. So we know we're earning more than 14% because we have a positive NPV, and we can solve for the actual return using the IRR button on our calculator. Easy peasy. Once you compute the net present value, you should interpret the results as follows. A positive NPV, as I already mentioned, indicates the project's return exceeds the discount rate. A negative indicates the project's return is less than the discount rate. If the NPV is 0, it means we're earning exactly the discount rate. So if it's positive or 0, the project is deemed acceptable because we're earning either the minimum at 0 or above the minimum if it's positive. If it's negative, the investment opportunity is not acceptable because we're not meeting that minimum required return. So that's how we utilize NPV to make decisions. Choosing a discount rate can be challenging. The company's cost of capital is usually required as the minimum required rate of return. The cost of capital is the average return the company must pay to its long-term creditors and stockholders. So if it costs us 10% in order to get money to invest in growth in our business, then our minimum return is going to be 10% because then we'll just break even on that investment. For our purposes, you'll be given the minimum return. I'm going to dive right into internal rate of return in this segment because we've already covered it. The internal rate of return is the rate of return promised by an investment project over its useful life. As I already mentioned, it's the return at which the net present value of the project would be 0. It works very well if the project's cash flows are identical each year. If the annual cash flows are not identical, it says a trial and error process must be used. That's only true if you're using the charts. When you're doing the beautiful HP10b, baby, you get it every time. Easy peasy. Hit the button for IRR and you're good to go. Gotta love it. Using internal rate of return in order to make an investment decision means we're comparing that IRR to the minimum. when the internal rate of return is greater than or equal to, quite frankly, the minimum, it's acceptable. When the IRR is less than the minimum, it's unacceptable. So when we're using the internal rate of return, the cost of capital acts as a hurdle rate that the project must clear for acceptance. So in other words, your IRR has to be greater than or equal to that hurdle rate, that minimum return required by the company. So let's look at a quick example. Decker Company can purchase a new machine that costs $104, and it'll save $20,000 a year in cash operating costs. The machine has a 10-year useful life. So in order to figure out our IRR, we need to define our cash flows. Cash flow 0 would be the initial cost, $104,320. Cash flow 1 to 10 would be the cost savings of $20 a year. So we pop that in our calculator. Down clear, get rid of the old stuff, put 104,320 in, negative because it's an outflow, and then the cost savings is an inflow because that saves money, and that's cash flow 1 to 10. So you just hit this 10 times, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Then we're going to hit the shift button and the IRR button, and it gives us an internal rate of return of 14%. So we would need to compare that to the company's minimum, and if 14 is above the minimum, we would accept the investment. If not, we would reject it. Little quick check action for you to try. So the expected annual net cash inflows from a project is 22 over 5 years. The project requires an initial investment of 79,310. What's the IRR? So take a minute to find your variables and use your HP10b to calculate it. And if you did it, you should have gotten CF0 equal to 79,310 negative because it's an outflow. CF1 to 5 would be a positive 22,000. And then when you plug it in your HP10b, you'll get your answer. So let's try that. 79,310 is going to be my cash flow 0. I didn't make it negative, so I screwed it up. I'm going to have to erase and start over. 79,310 negative, set that as cash flow 0. 22,000, cash flow 1, 2, 3, 4, 5, and then second IRR gives us an internal rate of return of 12%. Now I should have followed through on my screw up, and I'll do it right now. Let me put in that 79,310 as positive, and then put in 22,000 for cash flow 1, 2, 3, 4, and 5. Now when I hit the IRR button, it says no solution. The reason there's no solution is all my cash flows that I entered are positive. It just means I keep getting money. I get money initially, and then I get more money. So there is no IRR, there is no internal rate of return. It's infinity because people are just giving you money. So you have to make sure you pay attention to your positives and negatives. If you get no solution, don't panic. It probably just means you screwed up by not putting in your positives or negatives correctly. And there's the 12%. To wrap this up, NPV is often simpler to use. It really isn't when you're using a financial calculator. It's only simpler when you're using the charts. When you're using a financial calculator, NPV and IRR are equally as simple to find. The questionable assumption, though, is the internal rate of return method assumes the inflows are reinvested at the internal rate of return, which may not always be the case. You may not be able to reinvest your cash inflows at that higher internal rate of return. You may only be able to invest it at the minimum. That's just a downfall of the IRR method. If internal rate of return is high, the assumption may be unrealistic, as I already mentioned. It's more realistic to assume that cash flows are reinvested at the discount rate, which is the underlying assumption of the net present value method. So the net present value method might be a little better, it might be more conservative in making our decisions.